Hi, this is Nilus Mattive with Money and Markets TV. The filing deadline is almost here, so I thought I'd do one more video about taxes. There are some big tax issues related to dividends and other income investments, and it's important that you understand them in order to keep your wealth intact and to keep it growing efficiently. Let's start with real estate investment trusts. Like the MLPs I talked about last week, REITs get special tax treatment at the corporate level. That requires them actually, to pass along most of their earnings to shareholders in the form of dividend checks. And despite the massive real estate implosion, a lot of these companies have continued paying out solid income. The bad news is that, unlike the income from MLPs, REIT dividends do not carry any special tax advantage. In fact, they're actually taxed more heavily than most dividends because they're treated as ordinary income. Remember, dividends from common stock are still taxed at just 15%. Originally, this favorable rate was set to expire last year, but because of the latest tax package, it will remain in effect through 2011. That's another strong argument in favor of buying and holding solid dividend payers, as I've been advocating for years. So how do you take advantage of this special rate? When you look on your 1040 form, you'll see a box on line 9B for qualified dividends. This is where you enter dividend amounts that are covered under the special treatment. And when you receive 1099 statements from your broker, they should specifically note what dividends count as qualified distributions. From there, you'll probably have to use the IRS's supplied worksheet to figure out exactly how much tax is owed on those dividends. But generally speaking, you'll pay a much lower rate than you would on many other investment gains. Of course, there are a couple hitches you should be aware of. One, you're required to hold the stock for more than 60 of the 121 days surrounding the ex-dividend date. And two, you can't treat qualified dividend payments as investment income to get investment income expense deductions. However, you can forego the special tax rate and then use them to offset the interest expense. Other categories of income investments are also excluded from the favorable rate. Take preferred shares, for example. This special type of investment blurs the line between a bond and a stock. But not all preferred shares are treated equally come tax time. Only some qualify for the 15% dividend tax rate. These are known as traditional preferred stocks. In contrast, any income from trust preferred shares will be taxed at your ordinary income rate. That's because they're technically considered debt securities. So in addition to some of the other risks surrounding these shares, there's also the prospect of having your dividends taxed at a higher rate. Finally, I want to talk about mutual fund dividends. If you invest in mutual funds, you probably see all sorts of dividend payments, even when your fund doesn't invest in dividend stocks. That's because many institutions use the term to denote even regular interest payments. But the same basic rules I've just outlined will also apply to your mutual fund holdings. Dividends from common stocks will usually get taxed at the qualified rate. Most other dividends will be treated as ordinary income, and long-term capital gains will be treated as such. The tax statement sent from your fund company or your brokerage should break the categories up for you. Now, one word of warning. Reinvesting dividends can cause a lot of extra work and documentation come tax time, but you can avoid most of that by using some of the tax-sheltered accounts I've discussed here before, like IRAs, 401ks, and education savings accounts. In most cases, they'll minimize your tax homework, allow your nest egg to grow even more quickly, and lower your current tax burden to boot. For Money and Markets TV, I'm Nilus Mattive. Thanks for watching.